There was also, if you have part-time employees, you're supposed to add up all their hours, divide by 120, and take 9.5% of that. Take their hourly rate, take their current hourly hours that they're worked, calculate a monthly rate, and determine whether they meet the 9.5%.
What do you do with companies? A lot of companies have sales positions where they don't get a big salary or no salary, and it's all variable based on their success.
Okay.
How would they calculate that?
Well, they would, if they were previous employees, they would have a W-2.
Yeah, but if they weren't?
If they weren't, you probably have to look at their average earnings thus far in the last 12 months and determine whether, as a percentage of that, they exceed the 9.5%. I mean, ultimately, this was a guide. When they actually get to the exchange and try to enroll in the exchange and get a subsidy, the exchange, the calculators in the exchange, the .gov site, will determine and let them know whether they're eligible for the credit.
And really based on their previous, most recent W-2?
Yes, based on the IRS information. The system combines IRS system, Social Security, Medicare, Medicaid. It kind of goes and retrieves data from all those systems to determine eligibility. Now we know it's not all working very effectively, but that is the point. Any other questions? The small business tax credit. Anybody here take the small business tax credit, healthcare credit in 2012? So this credit has been around. It was designed to encourage small business to offer health insurance to their employees. Those of us in the Northeast would argue that this is very difficult to, in order to qualify for the small business health credit, you have to employ 25 full-time equivalent employees or less, and the average wage for those 25 employees or whatever count you have has to be less than $50,000. Now, when you calculate your average wage, you do not include owners, family members of owners, 2% shareholders. So essentially, maybe in a small business, you're kind of excluding the higher earners in that calculation. But in my population of small business health clients, I have had one. So a very small percentage of my client base has been able to qualify for the credit. And the maximum credit only applies when you have 10 employees or less, and your average wages for those 10 employees is $25,000. Okay, but if you do qualify, you also have to, for 2014, you have to buy your insurance through the shop, which is a little challenging right now. The credit is equal to 50% of the premiums that you as the employer pay. So and here you have to pay at least 50% of the cost of the single coverage in order to qualify. So the credit will be most likely 50% of the single coverage costs, the premiums that you pay that are not paid by the employee's contributions. And the credit is available for the next 2 years. Anybody think they might qualify for the credit? It goes on your tax return. If you're a pass-through entity, it will pass through to you individually through the entity. But if you think that you might qualify, I mean, it's certainly a valuable, but you do have to buy your insurance through the shop, which right now, the shop is not an active online vehicle to buy insurance, so you have to do it through a broker, manually, through a pretty convoluted system, but it can be done. So take a look at that.
Did you say it doesn't include the owners?
In calculating the average, it does not include the owners, family members of the owners, 2% shareholders, and an S corp. All right, the employer mandate, I'm going to run through this because there's really only one group of you in here. And my point in the employer mandate was another way to help lower the uninsured rate and assure that more consumers are covered. So essentially, they're creating a penalty for large employers. Employers that have 50 or more full-time equivalent employees must pay or play. So if they don't, there are 2 penalties. So the way they're encouraging participation in this pay or play is if you don't, we're going to charge you a penalty. I'm not going to go into the detail on counting employees and et cetera, because it's too cumbersome for this group. But what I do want to say is there's two penalties. There's what I'm going to call a hard penalty, and there's a soft penalty. The hard penalty is more substantial. The soft penalty, obviously, less. There are ways and strategies. We live in America, right? So whenever a new law creates a new issue, we've all got the creative types that come up with solutions. And there are solutions where employers can avoid the hard penalty and the soft penalty because of the way the law is written. The hard penalty is essentially you have to offer coverage or coverage that offers minimum essential value, minimal essential coverage, MEC. If you do not offer coverage, you are penalized by a flat charge per employee, less 30. So if you have 100 employees and you don't offer insurance, you will be charged $2,000 times 100 minus 30 employees. So 70 times $2,000, $140,000. It's a pretty stiff penalty for not offering, and it goes back to, should I or shouldn't I offer? The other penalty, the second penalty is you might offer insurance, but if your insurance is too costly and certain members of your group go to the exchange and get a credit, you are going to be charged a $3,000 penalty, but it's only on those that actually get the credit. So if 20 of your group went to the exchange and got a credit, you'd be charged times 20 times 30. The concept, the opportunity here is to offer a plan that satisfies the penalty A, which is a minimum essential coverage that is low cost to the employer and low cost to the employee. And by doing that, you satisfy a couple of things. A, you avoid the penalty, but two, the minimal essential coverage plan will meet the individual mandate. So all of your employees would satisfy that individual mandate and not be subject to any penalties. They will have something that's affordable. So I'm telling you, there are solutions out there where you can offer a MEC plan that is affordable to the employer, affordable to the employee, less costly than if they were to go to the exchange. So you eliminate penalty A, and because it meets the individual mandate, those employees are not likely to go to the exchange. You go and offer your normal plans that you've typically been offering to satisfy the rest of your group, and you've got very few people going to the exchange to get coverage, and therefore you eliminate the penalty B. So there are creative solutions out there. There's been a lot of talk when this all came out is, oh, I'm not dealing with this, I'm just going to pay my penalty. $2,000 an employee is far less than the cost of buying health insurance, and go let everybody go to the exchange. But what I would say to you again in our discussion earlier is, why do you provide benefits in the first place? It's been a vehicle to retain and attract employees. It's been a vehicle to be competitive with your competitors. And there's also plenty of documentation that demonstrates a healthy workforce is your most productive workforce. So if you leave it up to your employees to go take care of themselves, pull the benefits back, really what are you doing to your long-term business and your business strategy? And given that there are solutions out there, I would suggest that before anybody make that decision, they consider those. And also, just penalties are not deductible. Health insurance is. So when you're evaluating the cost, you got to look at the difference between the actual after-tax cost versus just the cost on its surface. All right, so this just went through the calculation. The penalty is 2,000 times the number of employees minus 30 if you don't offer anything. The second penalty, $3,000, but only per employee that actually goes to the exchange. So your only employees that are going to go to the exchange is when they don't have a choice provided by you that's viable. This is a great diagram. It's a metrics on how to make the decision as to where you fall on the penalty. If anybody's interested in that, I can send it to you. It really makes the decision-making process and understanding where you fall with respect to the penalty very easy to follow. And we talked about these business implications of not offering health insurance, deductibility of penalties versus health insurance premium.